Hey, welcome back to STRonomics. I'm joined by my good friend Kenny Bedwell from STR Insights. I'm Bill Faeth, founder of Build Short-Term Rental Wealth. Today, we're going to be talking about the future of Airbnbs, Kenny, the future of short-term rentals. What say you? I'm just going to sit back and listen and relax.
Well, I mean, what should we do? Should we do like a 3-year or sorry, a 3-month outlook, 6-month, 1 year, or like how are we how should we approach this, Mr. Faith?
I mean, I believe in a holistic approach, honestly, to this. And I think that we have seen some tremendous market shifts. I'll go back to Logan, Ohio, number one on your first ever, Kenny's first ever like top 200 or top 100 list, in Gatlinburg. And it hasn't been on the map since like probably the end of 2021. Right. So I think long term rentals, midterm rentals, short term rentals, I think any type of real estate investing is a sound investment if executed correctly. There's one thing that I think has to change to be successful for the future. And the buy and hold mentality is different in the short term rental space than it is in the long term rental space. Right. So, at least for me, I think that if you didn't get in prior to the mega gold rush in 21 or 22, you need to have a little bit shorter span or window of what you're looking at as a holding process for these properties based on your investing style, right? So for me, I mean, there's a lot of people, Kenny, that invest into the same market, right? And they'll do that for 5, 10, 15 years. And they've done that traditionally in the LTR space when it's an appreciation game. So I think, an old school LTR investor can move into the STR space and apply that strategy, take the tax benefits, grow off of appreciation, and break even, let's say, or make $500 a month in cash flow through using a PM, a co-host, or self-management. But they still have the LTR strategy. So I look at the short-term rental strategy. I'm investing for cash flow first. I'm investing for tax benefits second, and appreciation third. Or, you can intertwine tax and appreciation. I just say the tax because it's immediate, right, within that next tax filing. But those two things most people don't talk about. So the appreciation is the icing on the cake. The tax benefit is the icing on the cake. I'm buying for cash flow, right? It's like Pace Morby. Pace Morby is buying for cash flow. And the interest rate is a huge component to what he does, but he doesn't even care about appreciation, on properties. That's why he doesn't want to have to inject a ton of cash in. He's buying most of his stuff with OPM and like zero money down, but he's just looking at that injection of cash flow immediately. I think when people are buying businesses, coffee shops, automotive companies, whatever it is, they're looking at cash flow. There's not a whole lot of long-term appreciation. But I think one of the reasons that a lot of people have migrated into the boutique motel space is they're looking at that forced appreciation. And that's something that I do very well in the single family space, is that forced appreciation. When that happens, there's going to be a faster reposition time to either cash out, refi, and reinvest, or to sell. So because I'm looking to build based off of profit, making money, right? What was that guy's name? Johnny Football, right? Who used to do that all
Johnny
the time.
Manziel. Yeah.
I'm not here for the buy and hold. I don't want to have 250 units. So I think it really ties into the individual's investment strategy. But I think the short-term rental future is bright. There's too many options, right? There's too many long-standing vacation rental markets that are going to be standing 30, 40 years from now. There's also a lot of new markets that have not been penetrated or saturated because we're in a business, Kenny, that the herd follows the leader. That lead steer out in front guides 80% of this industry. And that's why you steer people into other markets. I steer people into other markets. I go to other markets. Nobody's investing in Whitefish, Montana, except for Jerry Norton and Pace Morby before I invested there, a year and a half ago. Outside of the traditional legacy people that are investing into Whitefish Mountain and some progressive locals that invested in that Coram area, that Hungry Horse area close to Glacier National Park, right? So you don't hear people outside of like your reports that you put out talking about national parks as investments. It's like, oh my God, there's, a new amusement park going into Frisco, Texas. I'm going to buy there. They go to Orlando because of Disney. They go to the traditional places. Nobody talks about the Smokies in the national park. They only think about Dollywood. That's all we hear about, right? Is proximity to Dollywood. Nobody's leveraging West Yellowstone. Nobody's leveraging Glacier National Park. Nobody's leveraging the 7 national parks, in southern Utah. Those are the things that I look at that are going to have sustainability. I mean, just look at fucking Michigan, man. There are so many opportunities in Michigan, but you and me are like the only people outside of Tony Stuncano and the people that live up there, the Carwells, that are really talking about those things.
Yeah. Well, yeah, the state parks, everything going on there. I feel like, and we're seeing this mass exit of people who aren't a fit for the industry. And also, we're seeing a lot of people who are trying to apply and are struggling, trying to apply the same ideology that I can buy a short-term rental in places that I love to. I would go on vacation there myself, and I would vacation at that property myself, and I wanted to cash flow as well.
That's a lifestyle asset. That's not an investment.
Exactly, but there's a lot of people with that, like, ideology still that, like, I can go and do that and acquire that property, and then they have these cash flow expectations. And so, in my experience and what I'm seeing in the market, is it shifting to becoming a more established market, a more business-oriented market, meaning that you are buying a business and you have to treat it as such, meaning you have to do your marketing, you have to do your due diligence. You have to do your underwriting pieces, stuff like that. People didn't have to do that 3 years ago. They didn't have to do it. They didn't have
But the
to.
people that have been in, like myself, since way pre-COVID have, right?
Yeah,
And I think that's the fundamental difference. I think, I had Ryan Bakey on my podcast, and he used to term the cost seg as the poor man's 1031. And now he's like, you know what? I'm trying to rebrand it to the lazy man's, 1031. The gold rush was the lazy investor time period, right? That's what it was. The dentists that have never been in short-term rentals, and I've got a couple of them as clients, came in and just bought, and then they hire me to co-host or whatever it is, and they could make a shit ton of money. Well, now, because the markets have thinned, and it's not as easy. And I think the people that have treated this, like myself, like a business with that mentality, have been successful prior to, during, and post COVID.
right.
The ones that are going to take that lazy man's approach, and there's nothing wrong with that. Look, I mean, like Sean Moore from Bodyssey, I love him. We've become really good friends, but I'm never going to make $800,000 investments and pay a PM 20 or 25% to manage my property, which is his model. That's just fucking stupid, in my opinion.
You're not going to make any money doing
If
it.
you're Joe Jakes, you can do that, right? If you're Lori Lochtefeld, you can do that. But you're right. For most people that are getting in, that's not going to produce cash flow, right? And all your cash is going to go to the PM, all your cash is going to go to the co-host, and you're sitting there basically in a long-term rental strategy, just trying to grow off of appreciation.
Right. And you have to learn how to do these things. You have to learn how to market. You have to learn how to do revenue management. You have to learn how to better improve your property through data and analytics. Whereas a few years ago, you didn't have to. You could set it and forget it. You could just list on Airbnb. You could never update your property or refresh your property or whatever it is. You didn't have to do those things. And it's now becoming a business. It's a lot more competitive. Okay. It doesn't mean it's bad to get into the industry. It just means there's a lot more effort that has to get into that's involved. And that's normal in a maturing asset class that we're seeing that's establishing. But you have to treat this like a business. So the future of short-term rentals for me is literally like the way I'm thinking about it. And I mean, it's not that I haven't been thinking of it this way anyway for the last few years, but literally for everybody else, it is a competitive business that we have to be essentially either pay somebody who's good at doing one of these things, or we become really good at those things, whether it's pricing, marketing, listing optimization, whatever that is. You can't be good at just one. You're going to have to find or partner or team or pay or whatever with people around you that surround you. It's the same thing in all the other industries that have matured over time as well. The hotel industry, that's the big one I've been thinking of. It's like, well, that when that matures, When that matured in time, they have to market more. They have sites, they have point systems, and all these like elaborate structures and things going on to attract people to stay at their brand. Okay. Well, short-term rentals, it's going to become like that as the competition heats up.
Here's what I'm gonna tell you, I think, and I'm gonna kinda piggyback on what you just said. I think that most everybody getting in that's buying at, like, specifically $500,000 and higher as a price point should have about $5,000 a month factored into their pro forma when they're underwriting. Did I say $5,500 a month, which is $6,000 a year factored into their pro forma for 2 things. And specifically, if they are not really good at these 2 skills, revenue management and marketing. Because literally, if you're spending $500 a month to pay somebody to do revenue management and also marketing, that's $250, $300 for revenue management, 250, $300 for marketing. You literally need one booking that you would not have got to offset that cost a month. So just the revenue management side, which is a part of marketing, and those 2 things go hand in hand. I mean, those are the super skills that have elevated me, to be able to do that. I think there's really 4 things, Kenny. There's the revenue management, the marketing, and that includes listing optimization, email marketing, funnels, blah, 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 blah. Revenue management is not just setting and forgetting price labs. There is research that's involved on a weekly basis. There is manual pricing strategies that ties into your ranking, ties into your revenue management, your pricing on your revenue management side ties into your listing optimization, your marketing strategy. Those are the 2 post-close skills that are critical. The 2 upfront skills before you buy are the underwriting process. That's that's locating a market, locating a property, buying the property, negotiating, the banking side, all that type of stuff that goes into the underwriting process, the data analysis, all of the stuff that goes into building out multiple performance to understand if mitigating your risk, if the property is going to, cash flow or not cash flow. Is it an appreciating market or has the market been stagnant? Like, would anybody classify Scottsdale, Arizona as an appreciating market today? Most people would say no, it's been going down, right? But I mean, the properties I've been looking at are down 25, 35% from 2 years ago. I look at as, what, I can go in and probably expect a 3 to 5% appreciation, over the next 5 to 10 years, because hopefully it's come close to hitting the bottom. I don't think it's going to continue to drop. Does that make sense?
Yeah.
So looking at appreciation, doing that historical. You also need to understand design. We talked about this on the previous episode a little bit. You and I both agreed neither of us have seen a property in the last 24 months that somebody has purchased and done 0 updates to and is just bought turnkey that has been profitable. It just doesn't work these days. If it was, people wouldn't be selling the property. So I think you need to have those 4 things. I call it underwriting, design, and, construction, design, ARV, renovation, whatever, and then revenue management and marketing. If you can really excel at those 4 skills, and I believe in the Tim Ferriss methodology, Kenny, I don't think you just need to get to that 75th or 80th percentile to be good at it. If you can be good at those 4 things, it's better than being an expert at one if you're going to keep everything in-house. That incremental growth in that last 5, 10, 15% typically is not worth the effort. So get really good, not exceptional at 3 or 4 things as opposed to becoming the best at one.
Bold statement alert, in my opinion. So my rule of thumb is, and I tell my clients, if you're buying,
you guys really see how conservative Kenny is when he says bold statement
bold
alert
statement,
before he drops something.
Yeah, bold statement alert. So my rule of thumb, and this is what I tell my clients who buy properties over 750, you're not going to learn revenue management like you should. You're just not. There are so many companies out there, and I'm picking on revenue management, but there's social media marketing, there's like you said, design, there's all these different levels. The reality is you're probably not going to learn that stuff. Okay. You're probably not going to put in the effort. And so you can hire people and surround yourself with a team of experts who can get you to that next level and make you the money as long as the ROI is there. That's why 750, my rule for especially revenue management is about 750, where I'm like, hey, look, you should probably just hire
someone.
You mean
$750,000 purchase price?
Price, correct. Yep. Because the revenue that they can generate is from someone managing their pricing who knows what they're doing, who's professional and everything, is just astronomical compared to 500,000.
But then it's the time that you save as well that
Exactly.
you can invest into doing the marketing or the design or whatever else, underwriting your next property. that goes into that.
Exactly.
Revenue management's cheap. I mean, if you find the right people, I mean, you and I have STRVAs.com, right? And we
Yep.
have revenue management for $300 a month, I think it is. Is that correct?
Exactly.
You know, you look at a meal, he's like $1,500 up front and $250 to $300 a month. You look at Jake, you know, there's these options. The ones I don't like are the ones that take percentages, you know, that are in the, 5, 6, 7% range. And I think there's a lot of options that you have for revenue management, just as there are a lot of options for marketing. You know, I mean, I'll teach you how to do the marketing so you can do it on your own. You can go to STR Digital and they'll do it for you. There's options that are out there. Market My STR, where we built almost all the stuff for you to be able to do it. There's a lot of options that are out there. You can go to Kenny or myself to help you, hire us to help you find a property. There's just, if you don't want to do it, you don't have to do it. I'm not, even though I co-host and, I'm an owner and Market My STR, Kenny and I are partners and, STR VAs, I still do everything myself, right? Because that's where I'm going to make the most money. And I'm willing to put in that effort now to max out my cash flow to reinvest until I hit my final goal. That doesn't mean that's right for you, right? You can hire out all of that stuff. And the reality is you can get a good revenue management source and a marketing source for $500 to $600 a month.
Yeah. And the so like when it comes to the future of short-term rentals, the way I think of it is it is a maturing, but it's still very young, but it's a maturing industry, a maturing business you're getting into. And there aren't very many maturing industries and businesses that I know of where they don't have teams running them. Like in terms of like specialized individuals working together to make that property or that business become successful.
I do think we're going to see that change though in the future. I think we're going to see AI change a lot of that. And it's happening right now. I think you're going to see plenty of 20, 50, 60, $70 million one person businesses because of the people that learn how to
Mm,
how to have
I can see that.
bots train bots that then train bots, right?
Yeah.
Is going to happen. And there's one guy that's on the forefront of this, and I'm not talking about in our industry that, I'm studying, and I've actually started building my own bots, training my own bots because I've had 700 employees in a business before, and I don't even want to have 10 employees, let alone 700 again. So, but I do think that's something that's going to change, but you still have to train that first bot then to train the next bot. And then you got to train that bot to train the next bot. You understand what I'm saying? It's very similar, deal to like virtual assistants and that type of stuff. But I do think that is one thing that will reshape our industry. And we see a lot of the AI coming into play. Really Hospitable was kind of one of the first with, AI in the industry. And, then everybody else is trying to implement AI. Now you got Future Stay with AI. You've got Bestie with, AI, a lot of these different AI tools that I think will make our lives easier in this space.
Yeah, and that's the thing too, like, you need to leverage technology. So, part of looking at the future is going, what else is out there? What is improved? Every single year, I love to do an audit of everything that I have to see if I can cut costs and expenses. And a lot of times, there's some stupid subscription I'm paying for that I can find something cheap. It's not just cut it; it's find something cheaper, or maybe they've changed their
Or better.
prices or better. Right, right. So, I think that there's going to be good opportunity in the future, but it's just going to be, you have to be at your A game. You have to be serious about short-term rentals. It can't just be a tax saving shelter or whatever and expect you to, oh yeah, I'll run it and we'll get all these bookings and whatever. But you got to be devoted
If
to
you want a
it.
tax saving shelter, go buy $1 million to $3 million airplane and put it at your local FBO, flight base operation, and have them manage it, pilots, everything, and take advantage of the accelerated depreciation on that. It'll be a lot easier for you.
Yeah, there you go. So yeah, and that's going to be the next big thing. So good job, Bill.
So I think the future is bright. Do you think the future is bright for short-term rentals?
Absolutely.
You just have to treat it like a fucking business.
Yep.
Awesome. We'll end on that. Thanks for joining us, everybody. Happy hosting. We'll see you guys on the next episode of STRonomics.